Hey, I have, I don't know, can I say special guest? Or can we be like the Bobbsey twins? Anyway,
I don't know. I mean, I'm
I,
not feeling that privilege today.
I would like to be your Bobbsey. Really? I feel like no. We're not going to kiss each other's asses just yet. All right, I got Robbie G here again. And in case anybody hasn't picked up on this, we are working together on a series that's somewhat topical and something that Robbie has a passion for, and I do as well.
The
And
only thing I know anything about, by the way. So,
is it?
yeah, I'm pretty,
Well,
pretty, pretty simple man.
somebody once said, "Do one thing and do it well," right?
Yeah, well, I think that's a whole other topic, but specialization, I guess, is a good idea.
Yeah, it's all good. It's an easy topic to have a passion for certain personalities, I believe. So, without further ado, we are looking to dispel some myths and maybe get into some definitions involving trading and investing, based on based on some of the things that we've seen from videos on YouTube, what we see on the media, and everything else. Robbie's been good enough to set aside a little bit of time today, and we're gonna get into some of this stuff. And I'd say we hit the ground running. And the biggest question that I can imagine having is, what is the difference between trading and investing? Because it seems to me the way that it's presented, a lot of times you see it presented as an either or.
Yeah, I guess it's, pretty common for them to be thought of as different, but they're really not. You see, you see people make the delineation and say things like traders are just speculators that are darting in and out of the market, and somehow that could be disruptive to investors. I mean, this really comes in a lot of forms, but I think it's pretty common for people to think of them as different activities. But in fact, they're all they really are, I guess, is sort of terms that people have come to use to think of the difference between short-term objectives and longer-term objectives. When it comes to the objective being the same thing, which is to speculate on a future price, whether it be higher or lower. The objective for everybody in the market, I mean, I don't care, whether you're a retail investor, institutional trader, retail trader, scalper, momentum player, arbitrage, or whatever. Everybody's objective is the same thing, and that's to speculate on there being a future price which is favorable to whatever your direction is in the trade or the investment. So to me, it seems a little silly to try to delineate between the two and say investing means something different than trading means. I think that it speaks to a need, especially on the investing side of the equation, and some of the people that have that misconception that they should think of investing as different than trading, because what I see a lot is that it's sort of an excuse not to manage your risk. Investors seem to be willing to sort of gloat when they're right, and then they never really have to admit if they were wrong because they just wait forever until they're right. And so,
Kind of one of those broken clock is right twice a day type scenarios.
right. We're typically traders, and when I say that, I'm using the term loosely because I really don't make any bones about not thinking of them as different activities. Traders tend to be thinking in terms of specific objectives, and really how long those objectives are for, how long they're in the market for making whatever speculation is really of no consequence. They're probably usually defining risk and reward in some way. It doesn't mean it has to be an exact price or amount of movement in terms of number of ticks or whatever. But yeah, that's definitely a myth. And also, of course, going along with that, the speculator term that's used negatively. Oh, speculators are ruining the market or whatever. It's like, who isn't a speculator?
Right.
It just doesn't make a lot of sense.
It's definitely with a sense of irony that there seems to be somehow the perception of two different terms for a group of people that are using the exact same vehicle to make money.
Okay.
We
should probably add as a caveat, though, that hedgers would be an example of somebody who isn't a speculator. It's a very specific activity, that has an entirely different reason for being in the market. But I think we can assume that, once we sort of break that off and make it as something really different than what we're talking about, anybody who isn't a hedger in the market is a speculator, whether they're an arbitrager or a long-term investor or a long-term trader, whatever you want to call it.
Well, let's you've briefly touched on a couple of quick terms that we really blew through, and I'd like to focus on them one at a time if we can. And that is these strategies of investing, trading, which again, I have in my own studies. I think people would be surprised how many traders refer to themselves as investors. People who the public would perceive as an evil pit scalper actually thinks of him or herself as an investor. But let's get into some of these strategies that we hear about, and we'll just touch on them one at a time. I've got a few listed here, and Robbie, if you can think of any after we get through this list, please feel free.
What's your list?
Okay, first up here, I've got trend trading.
Right. Just what you think it is. Obviously, betting on directional movement. Whether it's you're betting for a market to go up or to go down. Again, assuming that you've defined a periodicity. A trend is a term also that's that can be used a little bit assumptively. In other words, people assume a certain periodicity. So if somebody's looking, for example, at daily bars in a market, which is pretty common. I mean, most investors or traders, or kind of everybody in the world, sort of every participant in any market, usually daily bars, tends to be the way that people think of markets. It's a succession of days. So a trend, however, doesn't necessarily have to be something that you can only see in daily bars, obviously. And this kind of goes back to the trading versus investing, defining what the periodicity is. Because somebody could be a trend trader and he's really interested in capturing trends that exist in 30-minute bars rather than daily bars. Or perhaps capturing trends that only exist on 250 tick bars, which of course is a very short amount of time. Or maybe even weekly bars or monthly bars. So, in order to define what trend trading is, you have to define first what the periodicity is. But, generally speaking, trend or trend trading or trend investing means betting on a directional move in a market. And it can, it may or may not be tied to expansion of volatility or not. It just, obviously, that's a little bit of a detail there that may.
Well, now, real quick, when you were talking about periodicity, I'd like to briefly touch on that, because it seems to me that the time frames that we're looking at for these strategies, this is going to be a theme that will repeat regardless of the strategy that we're using. And if you can correct me if I'm wrong here, but a trend could exist in, say, one chart, and even though it's the exact same security, you may not find it on a longer term. That's where periodicity is so important. So I would have, say, I would have what I could perceive as a trend on a daily chart, but it doesn't exist on a monthly. Is that
Absolutely, yeah, and that's
okay?
that's the point I was trying to make. Is
Yeah.
you could look at a chart of a market, or even if you're not somebody who really looks at charts, even if you're just looking at a range of prices in a market over a particular period of time. If you're looking over a range of days, you might say, well, this market's in a range. It's really not going anywhere. It's not trending at all. So if you were getting long or short a position with that sort of periodicity objective, nothing would be happening. You sort of have this stale position where, like you said, you could look at another chart and you'd have this massive amount of activity. So they're definitely not mutually exclusive, and periodicity is very important, really, to any strategy. It's not just trending. I mean,
Sure.
You have to define what sort of time frame that you're talking about in order to really understand whether your objectives have been met or not. So,
And you have to stick with that time frame throughout the strategy. That's kind of a pet peeve of mine with some.
Or employ multiple time frames in a strategy, obviously. But yeah.
Well, I've seen some people, and I don't want to just. This isn't going to be a pick on people video, but I've seen.
Why not?
Because it's too easy. Where people cherry pick periodicity to match some sort of a notion that they have about a price, and the mistake, the way I see it, the mistake with doing that is that if you're trying to match data to your notion, that's not how you make money, because the data could really give a shit about your notion,
I agree. Data does not know who you are.
So, in a nutshell, layman's terms, I'm thinking of a trend here as you see a bus going down a street. The street appears long. It's a third of the way down the street, and you get on that bus expecting it to make it to the end of that street before it turns.
Which it may or may not.
It may or may not. But the idea with a trend is my strategy goes along with that bus not turning.
Directional movement.
Yes, it's going to hold its directional movement.
Betting on continued movement.
Awesome.
Or a beginning of movement in a specified direction.
We would with that plays in very nice into counter trend trading.
Right. Counter trend trading it's just the opposite. Either you're betting on a reversal of whatever the current direction is, and again, it's going to be specific to the periodicity that you're after. Typically, counter trend strategies tend to have a sentiment component to them, where contrary to popular opinion. So, obviously, counter trend trading really ties into the auction nature of markets. And of course, what happens is when you have let's say you have a tremendous amount of aggression on the long side, but obviously there's never any more buyers than sellers in a market, never more sellers than buyers. Markets move based on aggression, whether the buyers are more aggressive than sellers or vice versa. So typically, obviously, if you have a market that's long trending, more often the buyers have been more aggressive than the sellers. But counter trend traders, typically look for spots or predict or try to find spots where that pressure of aggression sort of keeps building. Keep trying to lift the offer and piling volume into it, except it's not moving anymore because it can't find enough supply to sort of provide the fuel for the continued move. And typically what happens is when that dries up, then obviously you're going to have an immediate reversal, and then what happens after that typically is responsive selling in that case, because now people who were long start thinking, oh, it's starting to go against me, maybe I need to take profit. and then maybe new shorts come in because they're finally seeing this reversal of that they anticipated, or that they were are waiting for this particular signal in price to show. So sort of contrary to popular sentiment. Kind of.
Now, counter trend trading is also referred to the slang term fade, correct? Do I have that right?
Yeah, some people use that to mean only one direction.
Okay.
Fading means always, selling into upward momentum. But like in our firm, we think of fading as bidirectional. Fading the move is either buying against the short move or selling against the long moves.
That's cool. Now, with again, to use my layman term, with the bus, the way I sort of see it in the simplest possible terms is the bus. I see the bus going down the road, and I think there is no possible way this bus is going to go any further without going ahead and turning around. I've just got this notion that this bus is going to turn around, switch directions, because either
washed out road, potholes.
Yep, it's run out. I've never seen it move past this point. I'm going to hop on now because I think it's going to go the other way.
Right.
But now,
and you'll get your liquidity, by the way, from people who are continuing to bet that it will, which is how you'll actually enter.
So, like, I'm actually going to be, when I'm doing a counter trend, I'm actually getting buyers from people that are following, say, a trend strategy, perhaps. Then,
right? Absolutely.
Interesting the way that plays in, isn't it?
Yes, it is. Yes, it is. It's always that way, of course.
Now, both of these, I feel, really do a good job of bringing us to the next type of trading, and that is momentum trading.
Right.
Which I would a momentum trading be a lot closer to trend than counter trend per se? Or?
Actually, both.
Yeah.
You could bet on a very fast reaction because of what's happening in the order flow on a counter trend strategy, which actually becomes momentum strategy in either direction. Obviously, whether it's fading a move to the short side or to a long side, that you're sort of expecting a violent reaction reversal for one reason or another. And of course, on the trend side, it's pretty obvious. Momentum players it sort of tends to be a subset of trend trading and counter trend trading, but usually there's something that's pushing the market beyond its ordinary auction activity, which always tends to lean one way or the other in terms of more aggressive buyers and more aggressive sellers. But so certainly news events come to mind as something that momentum players look for, like whether it be earnings reports or economic releases or something that they are speculating is going to have a potentially dramatic effect and not only cause it to move in that direction, but with a little bit more tenacity and angle, as we call it. So it's sort of a specialized subset of either of your first two.
This actually reminds me of a Tim Sykes story, and Tim Sykes,
the most famous short seller of pink sheet securities of our day right now.
Well, the point is, and he's good looking too. Just ask him.
Well, if you're gay, I guess you might look at him that way.
Hey, it's 2013. I heard the rules changed, but he had he was one of the traders featured on Wall Street Warriors, and he had a particular security, and I don't remember what the actual one was, and I don't think it was actually named, but it's really pointless, and I wouldn't want to name it even if I did know the name. But the idea was it had a very favorable advertising and big push, a big thing on CNBC, and all of a sudden he noticed the value of that security go up, and he was sure that the earnings did not match the the value. So what he did, he shorted it at the peak of that momentum, expecting it to almost slingshot back. Now, is that kind of
yeah, actually, momentum leading up to and actually creating a counter trend move
right?
is a very common strategy amongst traders. I mean, it's not specific to what that guy happens to do, but
Well, I felt he made he served as a good example for me.
yeah, he would definitely be in the category of and if you it's always tricky to kind of coin somebody's specific strategy using simple terms, but because there's always a little extra something that might be critical to what he's doing. But I would say he would fall into the category of a counter trend momentum trader, very much. And he, maybe even momentum on the other side too, as a result of that. But momentum that is gaining this tremendous amount of aggression in one direction. Obviously, if that stalls, it tends to create an equally or perhaps even more violent reaction in the opposite direction when people realize that they bought into the top and they're hung. And obviously, them exiting their positions provides just gasoline for the short on the other side. So obviously, I mean, it's just, all these markets are auction markets. So it's the same thing it would happen in any auction when somebody, imagine somebody's trying to buy, classic cars or something like that. And it's just this really frenzied auction and it's screaming up and all of a sudden there's this really high price. And then all of a sudden the auction sort of comes to its senses and goes, wait a minute, why am I buying a Yugo for $200,000?
Right.
And then, of course, when that bottom finally drops out, you tend to get that equally or even more so violent reaction from the realization that you have no chance of ever finding a profit, and you're going to lose money on what you just bought. So you're 100% focused on stopping the bleeding and minimizing the damage. So, and that tends to be, incidentally, what happens a lot with these really thin, illiquid securities of startup companies and things like that. They tend to draw a lot of frenzy because the type of people that tend to trade those securities on the long side tend to be, for lack of a better term, they're looking to be the first ones in on the next Microsoft or the next Google. So they tend to have a lot of passion about it, and that kind of unbridled passion can be easily and violently undone the more unbridled that it is.
Yes.
Right? So sentiments and of course fear and greed, especially fear. Fear is far more powerful than greed in my experience, and that's why in any market, if you look at moves to the long side, you look at the most aggressive move to the long side, all things being equal, of course, in a market, and then you look at the most aggressive move to the short side, all things being equal in that same market, by and large, you're going to find that the moves to the short side are far more violent and deeper than what you see on the rally side, and that's just because the fear of losing money is much more powerful than the greed of imagining what you can make.
Okay, man, this next one's going to make you think that I've been softballing you to this point, but arbitrage trading.
Softball, isn't that like a kind of candy?
That's like when you ask a guest easy questions to make them look good.
But wasn't there a ball like soft? Isn't that like the softball stage of like if you put sugar in water and? Isn't that
Oh, you're thinking of, is it hardball? Hardball or softball?
Too. Candy.
Yeah, it's a candying temperature.
Well, there's something relevant to this discussion.
Yeah.
Sorry, I digress.
Yes, arbitrage though.
Arbitrage, yeah. Arbitrage is exploiting typically statistical differences in two or more securities that are expected to to be extremely correlated, typically. It can take the place in derivatives markets, markets like the futures markets and options markets, where you have current month and then future months of expiration, where obviously the front month and the back month are trading at the same time, and they're supposed to have a reasonably perfect parity, but for different reasons they get out of whack by a little bit, and arbitrageurs try to exploit that price difference by betting that the one that has diverged from the other one is going to return to its former state. So they would simultaneously buy the front month, for example, and short the back month, with the idea that they're going to capture that discrepancy and actually not lose anything from one side while they make a very small amount of money from the other side as it comes back to parity.
Now, would the risk on that, of course, be, what if they pick the incorrect side on that? Like if the other one goes to the divergence?
There can be tremendous risks in arbitrage, actually.
Yeah.
Because specifically related to correlation-based arbitrage, where you are you're counting on that correlation to always be there, or at least return to what it was in the short run. And of course, from time to time, what happens is two markets that are tremendously correlated all of a sudden, because of news, for example, in one of the companies. Something that might come to mind might be, airlines or something like that, where two airline stocks are typically very correlated, but then there's some crazy event, whether it has to do with the structure of one company or a buyout or something like that, and so there is this big divergence in the price and the correlation between them, but it never returns to what it was before. So obviously, risk management is a big thing in arbitrage, but typically arbitrage strategies tend to have a very linear return series. Like, they kind of always make money except for the one time when they don't. So they tend to have a very, very smooth return series of and a very, very high win rate, and then occasionally they have fairly large losses that occur, and of course over time, when you add all that stuff up, then you have the overall performance of the strategy. Whereas other strategies like trend following, for example, are typically not smooth, because depending on how vast the strategy is and how many markets that you're trend following, for example, in a specific way, well, not all markets are going to trend. So if a trend isn't there, obviously you can't profit from a trend following strategy in that market.
Correct.
If it doesn't exist. So you might go through periods where there just isn't any trend activity, and then it trends, and then there isn't any, and then it trends. So you tend to have a fairly rocky return series with the trend following. And what trend followers typically like to do is to try to make sure that when the markets do trend, that they tend to make a little bit more from that trending activity than they do when the market isn't trending. And then when you sort of add up all of the frequent losses and you add up the frequent gains are a little bit bigger. So, A minus B equals C. Well,
I would imagine a responsible trader, regardless of the strategy, would run their risk reward likewise, though. Correct?
Well, yeah, certainly the how you risk manage the strategy is very specific to the expectation of the strategy. And these strategies that you've mentioned, each one of them has its own sort of basis from which you need to sort of understand some things that tend to reoccur in order to build that risk model. So, for example, arbitrageurs don't use really tight stops, obviously, because they might have to wait a little while for the trade to actually play out and happen. Whereas other people, maybe momentum players, for example, are fairly famous for using tight stops, because it's sort of, okay, here it is. It's starting. I'm betting that it's starting, and I'm going to know really quick if I'm wrong.
Yeah, we want to know. Well, we want to know as quickly as possible that we're wrong, so we can get the hell out of it before
Right.
we get our face ripped off.
Right. So typically a momentum player isn't going to use big stops, because he'd just really be wasting that part of the risk model, and he needs to really be concerned with the reward side of the equation, and how to pair that up that fits with what the strategy is, for sure.
Would you at all be, while we're still on the subject of arbitrage, would you be willing to take a turn down a dark road, perhaps, as it relates to arbitrage? With my next question.
A dark road.
A dark road. So, do you remember that British guy on the Millionaire Trader show, the one with the mole on the side of his face? The one that was running the phones for him, watching the people
Which
and
show?
stuff?
Wait a minute. What show are you talking about?
That Millionaire Trader show. The series from a few years ago, where they took all those people off the street and had them trade.
Yes.
Okay, when he was working for Goldman Sachs, I believe it was, he would, whenever they had, it wasn't really closeout stocks, but if they had stock positions that clients couldn't cover, he was able to exploit the price differences of those client stocks being returned. Is that arbitrage as well?
I wouldn't really classify that as arbitrage. I mean, that's a really strategy specific thing that I'm not so sure how I'd really classify that, but I wouldn't really put that in any of the broad strategy camps.
Yeah, it's a pretty hardcore thing.
And I'm not sure that that's a road. I mean, we could go down that road, but that really goes into a whole.
It's a little off topic.
Other thing, yeah.
Okay, I appreciate you. I appreciate you clarifying that for me.
I mean, he's discovered an edge, obviously, in that has a lot to do with the structure in which he's working with, but it really doesn't fit into any of these.
I mean, just to talk about him for a second, he has a long interview on there on the YouTube somewhere that I'm not going to bother to link. Anybody who's curious can find it. But he actually gets into great detail how his desk did that. It was kind of interesting. But I appreciate.
You talk about the English guy?
Yeah.
Yeah.
The guy, Mr. Outer Space.
I forget his name. He used to run I think he used to run a desk for Goldman, if I'm not.
Yeah, that's what I was thinking when he was with Goldman, and they were taking these return stocks, and they were able to actually exploit the value change.
Yeah,
when the clients couldn't cover
inventory related stuff, but that has more to do with a market making function and how much supply that they have. But like again, we don't want to go down.
It's
real complex, yeah. But.
Well, if we. I say we make it not complex. Last thing I have on my list here, and it says as little complexity as possible. Buy and hold, baby.
Buy and hold, yeah. Just certainly a viable strategy, and although it's funny, I think amongst guys who fancy themselves active traders, particularly day traders, you hear people say things like "buy and hold is dead," or buy and pray, or whatever. And I mean, certainly buying and holding assets it can certainly be a very different strategy with a very different expectation, depending on whether you manage your risk and or your reward objectives in any way, or if you don't. Unfortunately, buy and hold as a strategy, and obviously this is what's been perpetuated by the retail financial advisor types, which have a lot of different roles and different classifications. They kind of feed that as being the most popular investing strategy amongst retail, because it's easy on them. Frankly. They're going to make their fees no matter what, and so the idea is just hold on we'll get through this. And by the way, I keep taking my cut, regardless of whether you make money or not. And that's form follows function.
Well, and it doesn't take us too much searching also to discover that some of these buy and hold places, like at the worst possible time, they'll get their investors to do what's called dollar cost averaging. Like the price goes down, they get them to buy more, but the guy selling it to him gets his commission again either way. So he's getting a commission bump regardless of how well it does.
Right.
But I think out of anything, buy and hold, and this is something I think perhaps people may be unaware of, the periodicity is every bit as critical, if not more so, than any of the other trading strategies that we've talked to this point.
You're 100%, 110% right about that, and the reason is really pretty simple for anybody to see, and it's really a twofold process. And the process is, number one, to look back at any market in history, and just to make sure that it's totally complete. Maybe go back 50 years or 100 years, and what you'll notice about any market is it never moves. Not only does it not move in one direction, but at any given point in time, and we'll just call it a year, right? If we just separate it by years, at any given point in time, relative to a previous point in time, it's pretty much rolling the dice of what the price of it is relative to the time that somebody, quote unquote, got in. So, for the buy and hold investor that doesn't manage risk in any way, that's basically wants to contribute or acquire something at a certain point in time, the idea obviously is that at some point you're going to need the money. At some point you want to cash out. For most people, that usually tends to be retirement. So what typically happens is, you just take a guy that's 40, 45 years old and doing okay in his job, and he's making his largest sort of contributions to say buying a U.S. stock index or whatever, and he's holding it. The question is in 20 years, with all of these factors that have various pressures on these markets at different times, the likelihood that it's going to be up based on your initial investment or down is pretty much a crapshoot. Who knows what it's going to be? So if you don't have any other component into it, it really doesn't matter what it is. You're really taking a 110% flyer, as it were, and just hoping that it's going to be, at this preferential price at the time that you need the money. And I think the real disconnect is even people that believe in a particular asset class. Certainly metals have been one lately. They've got a lot of attention from retail. Whether the metals have long-term value or appreciation or whatever really it doesn't come into the equation, because any factors can cause the opposite to be true in the short run, even if they're right in the long run. It's just a question of that timeline and where you happen to land on the point at which you need the money. So you could be 100% right about silver going to $1,000 an ounce, but the harsh reality is it could be at $10 an ounce 2 years before you retire, and then it goes to $1,000 an ounce. And so you were right, but unfortunately, you didn't get to realize anything, and you just flushed all your money down the toilet. So, not having some sort of an objective for reward tends to be really dangerous for buy and hold.
I'll tell you another.
There's a lot of great success stories. I don't want to leave it sort of on a bad note with buy and hold. You could get lucky.
Oh, sure.
You need to be a guy that made your biggest contributions to your long equities investments and bet on America throughout the 80s, right? And you retired in November of 2000, right into the peak of the tech rally, and
there were guys that did it, definitely.
Absolutely, there were plenty of guys that did that, and but that's not an excuse to say that we can ignore the fact that the people who happened to retire in January of 2001, or worse, October of 2001, or whatever. You know what I mean? It's
Well, that's the thing that I'd like to briefly touch on too, is that you and I could probably sit here and together we could come up easily with 100 examples of proving our case either way, as opposed to whether buy and hold works or buy and hold doesn't work, and easily be able to manipulate our audience by cherry picking which examples we wanted to use.
sure.
If we had nefarious intent, meaning we were going to deceive them into buying a product from us, I mean, you and I could easily sit here and give you 100 examples following 100 years worth of data and make a convincing case.
Right. Well, the metals guys, did that a lot. I saw a lot of videos where the metals guys would say, would try to encapsulate the value of the gold or silver market by starting at 2007 and going through 2012 or 2011.
Yeah.
And of course, if you started in 1995, you get an entirely different picture in terms of compound annual return to date. It's pretty bleak, actually.
Well, now, and we're not saying that, of course, to beat up metals. I mean, it's squiggly lines on a chart just like anything else.
That's it. Metals are just as good as any other market to me. There's opportunities sometimes, other times there's not opportunities. Don't fall in love with anything. I think that's the lesson. Don't get emotional.
So let's.
I think Gordon Gekko said that.
Gordon Gekko said a lot. I was almost going to use.
Don't get emotional about stock. It clouds your judgment. That's what he said.
I can't find that movie anywhere.
Wall Street?
For sale? Yeah. I mean, I can order it online, but I want to put on my Gordon Gekko shirt and watch it.
Yeah, you got to have the gecko.
I got to have the gecko if I want to make it in this town.
Everybody needs a gecko in the back of their closet. For anybody who doesn't know, that's a dress shirt that has a color and then a white collar. That's the gecko.
It just reeks success and wealth.
Yeah, well, or at least it did in 1985. I don't know what it says now.
I don't know. I watched a video on multi-level marketing, and the one guy that was running this dildo thing, he was wearing the gecko. I'm like, son of a bitch, he's wearing a gecko and selling dildos. Of course,
well, there you go.
My wife was watching, well, not watching the dildo thing, but watching the thing too. She didn't know what the fuck I'm talking about. Shut up, you dumbass. That's what she said. So, hey, Gordon Gekko. Now so Gordon Gekko then, he was a fundamental guy, huh?
Yes, very much so.
Well, we've talked about strategy, so with Gordon Gekko and fundamentals, how about some methods here?
All right.
I got on my, I took some notes to beat you up with.
You're a note-taking kind of guy.
Dude, I got lists everywhere because I'm visual, and it's not that I'm so smart. I just write stuff down so that I don't forget it. It's amazing.
There's a picture of you next to thorough in the dictionary.
Henry David or just... All right. Quantitative methodology, would that be methodology versus fundamental methodology?
Right.
If we can briefly touch on the, compare and contrast those two.
All right.
And I know you are you've mentioned in the last video that your business is mostly quant. So I'm going to start out. I'm thinking we start out with fundamental stuff.
All right.
And something real quick that I like about the fundamental thing. It is entertaining as hell to me to watch. Especially a person who's squared away, who has data that makes sense. I enjoy listening to a fundamental person's rhetoric.
Yeah, sure. That's certainly very viable. Fundamental trading or investing. Hopefully now we've got everybody thinking about it. It's just the same thing, just quite periodicity defined, right? The fundamental trader is interested in fundamentals, whether it's earnings from a particular company, maybe a hotshot CEO's taken over, maybe they had a merger, maybe there's a buyout, could be economic releases, trading on employment numbers, retail sales, ISM Manufacturing, the Fed, changes in the money supply, currency considerations, correlations related to those things in other markets.
So wait, real quick.
Yeah.
You just mentioned correlations in other markets. You would categorize that within fundamental trading?
As long as they're fundamentally related, yeah. I mean, those things could also be quantitative if you're talking about trading based on those things numerically within the individual instruments that we're talking about. But when I talk about correlation as it relates to fundamentals, things like Japan changes the bank rate, and normally you see a certain reason to buy or not buy a stock that's very, very tied to lending in Japan because it's a Japanese car company or blah blah blah.
Well, no need to get like terribly specific. I mean, it could be anything. Japan.
Yeah, but you have a fundamental reason for looking at how something like an interest rate market reacts.
Okay.
To something, to tie to that. But that would be that. So that's the limit of fundamental stuff. I mean, sometimes it gets really deep for those investors in terms of the whole analyst game and really studying what's going on with what the officers in the company are doing, where they came from, how good they are at their job, really specific things that are going on, the contracts that the companies are pursuing to get business, which is potentially going to add to the bottom line, which potentially might make the stock price go up, things like that. So, fundamental analysis can be fairly shallow, or it can be very, very deep. And again, what we're talking about when we talk about making this distinction between fundamental and quantitative, we're talking about the reason for putting the position on and or the reason for taking the position off, right? We're talking about two sort of broad camps of here's why I'm going to trade or invest in this particular stock or whatever the instrument is or commodity or whatever, and then once that reason has been determined, then as a subset sort of under that, now you're in. Are you trend following it, or is this a counter trend thing, or whatever, as a result of the fundamental stuff? Likewise, on the quantitative side, which we'll get into in a second, if you have a quantitative reason for actually initiating the position or exiting the position, then once you're employing the strategy, what's the strategy? Is it a trend strategy relative to that quantitative information, or a counter trend strategy, or momentum, or arbitrage, or whatever, right?
Yeah, I would say perhaps a good bridge between fundamental and quantitative would be chart analysis, because you have some fundamental chart analysis where a head and shoulders would be a fundamental chart interpretation.
I wouldn't go that far.
No?
You're getting to head and shoulders chart patterns, and that specific chart pattern as a reason to trade would definitely fall under the quantitative camp.
Really?
But what caused that move, if it was something that you could tie to what was going on in the company, then now you're talking about a combination of two things where maybe you actually traded based on the fundamental reason, and then a quantitative guy would say, well, I traded too. Right?
Okay, because I appreciate you clarifying that for me, honestly, because I had sometimes seen some chart technicians, to me, occasionally seem almost mystical in their interpretation of what they think the price will do.
The combination of both, fundamental and technical are very very common strategies amongst all sorts of investors and traders, retail and institutional. To be honest with you, I think that who knows what the numbers are in terms of percentages or who's doing what, but I'd say it's they're definitely all out there. There's certainly 100% fundamental traders, and then there are traders that use a combination of fundamental reasons and quantitative reasons, and then there's 100% quantitative traders.
Fundamental definitely seems to get the press, though. You know, whenever.
Well, sure, because the quantitative stuff is it's boring. I mean,
Yeah.
nobody. It's not. It doesn't have something that's tied to a world event or a human being or some kind of a sizzling story or reason that makes news. So it only stands to reason that fundamental would sort of get the most press.
Well, then let's talk about this quant then. Quantitative.
Quantitative trading is can be either predictive or non-predictive.
Now, real quick, would predictive quantitative bridge the gap to fundamental or no?
Well,
or do you just
some of the you're tough, man. Some of this stuff. If a guy who's doing a combination of fundamental and quantitative analysis might have the parent reason for putting the trade on be fundamental, and then he would actually look to the quantitative or the technical reasons to confirm whatever bias he had that was based on fundamental.
That bias meaning either long or short.
Right, or to trade at all, right?
Okay.
Whatever his opinion was that he had seen fundamentally, he might look for a confirmation technically and something that he sees in the price action or a chart pattern or something like that would be pretty common.
The only reason why I had you clarify that is you have made many mention that most of the models that you have built over your career have been non-predictive.
Yes, certainly on the algo side for us, everything that we've done is non-predictive, meaning that we don't have any opinions about what's going to happen next in the market for any reason. And so the quantitative measures that we use are, for lack of a better term, just things that we use as a way to segment the market into a prospective event series. In other words, as good a places to trade as any for us to apply our risk models, which is where our edge comes from, rather than our edge coming from being able to predict what the direction is going to be over a specific periodicity. So, and that's one style of quantitative trading. And another style of quantitative trading would be chart patterns, which is actually probably a little bit more common, especially amongst retail traders, where they use a variety of indicators, which are history. So they're using things like moving averages or oscillators, trend-following indicators or range-bound type indicators that have looked at whatever has happened in the market over the past number of days or weeks or months or minutes or hours, and are then using that as a way to predict what they think might happen next, to actually be used as trading signals.
So that we can actually categorize as a predictive quantitative model then.
Absolutely, yeah. So they might have something like if they were a trend trader, for example, if in their particular periodicity that they're watching on the chart, if the market's been trending and sort of moving up and then pulling back and moving up and then pulling back and moving up and pulling back, they might draw what we call a trend line underneath the pullbacks and sort of into a straight line. And the next time that it goes up and then it pulls back to that trend line, they might enter a long position to continue to try to hop on this trend that they're hoping will continue and go to whatever their target is. And of course, there's a million different variants of how they might do something. Or a counter trend trader, for example, this is where the strategies come in, might use something like an oscillator, for example, like stochastics or one of these things where they would look at a historic series where the market is kind of moving in a range and it keeps sort of running up to this area of resistance that it's gone up to before, and what they're going to do is, even though the market's moving directionally up, and then it runs into this this area, and they might call it something like overbought. In that instance, that's a term that's used a lot. They'd short the market into the move up to that line of resistance again, betting that it was just going to come back and to the mean, basically like a mean reversion trade. So, there are a million different reasons for initiating a quantitative trade. I mean, everything from pure price, which is typically what we're interested in, to things like standard deviation, to average true range of the market, to all of these indicators, like we said, or moving averages, things like the 50 period moving average moves above the 200, and that means the market's bullish, so they get long there. And when it comes back and it moves under the 50 moves under the 200, they get short. And pretty much everything you could think of in terms of technical chart analysis. And what they're doing, obviously, is they're studying historic charts and saying, well, this looks like it works pretty good in the past, and I think that I can make a return from these signals, and that's kind of the world of quantitative trading.
Now, for the pros, the institutional traders out there, is there a particular preference for institutional?
No, I think it's. I mean, yeah, who knows? I mean, you could probably do a survey of every tier 1 bank and hedge fund and CTA and pretty much anybody who's either managing money or is trading on the proprietary side that's a professional, and there is probably an edge to one or another in terms of what's more popular, but there's certainly plenty of everybody on both sides. Okay. The typical fundamental trader on the institutional side, whether it be a hedge fund or a bank, those programs are typically, again, if we're talking about equities programs, which is certainly the most popular amongst people who are probably listening to this, but their programs are usually really analyst based, where they'll, a typical fundamental discretionary type hedge fund will have a whole fleet of analysts. I mean, we're talking about a lot of employees that really do nothing except for sort of shop for names, as we call them, which is a name meaning a symbol, for a company. And they shop for names that they think have opportunities that are kind of related to whatever this particular fund's objectives are. And you talked about Tim Sykes earlier. I mean, I don't really think of Tim Sykes as a fund manager, but if he were, he would be, and maybe he is, but I'm just
ironically he used to be.
Oh, okay. Every manager has an objective, something that they like to do. So their analysts, for example, might only look to short companies. Think companies that they really think are weak managerially, or that they like to short sell, or other ones that maybe only focus on the tech space. That are looking for real breakout plays of like high growth kind of names that they want to risk a little and make some big rips, and they're not going to be right a lot. But so they analyze a basket of companies, and these analysts, whatever their objective is, whatever their little niche is or what they want to do, these analysts are incredibly thorough. I mean, you're talking about people, they're flying out, they're meeting with officers in the companies.
Yeah, that's something that I was going to get you to emphasize that the audience may not be aware of, is just how thorough these analysts are.
Right, and it's an interesting kind of dance, because of course, inside information, companies have officers, within the companies that are any publicly traded company, who's sort of the liaison for all this stuff, because of course you can't tell them about any contracts that you haven't signed, that haven't come out as news items yet, because then obviously anybody that knew about it would be front running, and of course that's illegal. So it's really a dance of this flow of information. But anybody who's like a hedge fund or a bank is going to really take a serious position and bet on a company by putting all that cash on the line is they really want to be well informed. So they really want to get under the fingernails of who are these managers, who's the CEO, who's the guy who's if structured finance is really important for the success of the company because maybe they're like a conglomerate and they're in the mergers and acquisition business. Who these people are and how good they are at their jobs, and are they going to fumble the ball? And they really want to know what's under these people's fingernails. So that's a big part of it.
Now these analysts though, they're not exclusive just to large investment banks like Goldman or JP. I mean, even a company like yours, if you decided to do business in such a fashion, you could employ some of these people, right?
Well, yeah. I mean, there's both. I mean, you have analysts that sort of put recommendations out that everybody follows and things like that.
Right.
And that's a whole other kind of weird thing in the industry. That's again, there's like a whole other subset. But what I'm talking about particularly is hedge funds or banks that are particularly employing somebody for a position called analyst, where their job is basically to study companies and then report back to the portfolio manager or whoever in that case is to say, here's what I dug up and here's the opportunity I think, and this is what I think we should do, and I think we should acquire this block of shares for this company, and if we do, this is what I think we can make off it. And typically they have committees where they kind of hash things out and figure out what they want to do, and then they decide, here's the plays that we're going to make for this year, and this is what we think we can make off of them, and they work some size, and obviously the trading side is part of it too. And they have to be careful if they take a large position for market impact. Try to make sure they can get the position on and get the best price that they can without moving the market. When you're talking about a large position, so it's a big deal. There's a lot that goes in. Of course, there's a lot that goes into trading at a professional level anyway. It doesn't matter if you're on the quantitative side, or the fundamental side. It's fiercely competitive, and you really got to know what you're doing, and you got to have all your bases covered, and it's not easy. But so on the quantitative side, it's the same. It's just different in terms of what the study is about. Typically, it's about historical testing and forward testing and a lot of what-if scenarios of, okay, we know that this is how this particular quantitative analysis performed in the past. This is how it performed when volatility massively expanded into the fourth quarter of 2008 and the first quarter of 2009, as compared to when volatility was quiet. This is how this quantitative strategy performed into September 11th, into October 87. Can we survive this with that risk model? A lot of what-if scenarios, a lot of studies. What if is this going to unravel? This idea of taking positions, bouncing off trend lines in this particular periodicity. Where's the elephant in the room, or the 500-pound gorilla that's going to crush us, and all of a sudden it just doesn't work, and we have 50 losses in a row, and we've never had more than 5 in the past. The past doesn't predict the future. So building quantitative programs involves a tremendous amount of study. Typically, the programs, especially the ones that are run by Tier 1 banks and certain hedge funds, you tend to find guys there that have PhDs in chaos mathematics and nonlinear regression thesis analysis and really heavy duty kind of math guys. We're kind of different. We don't believe in any of that horse shit. We think that it's nobody knows what's going to happen next, and none of that stuff matters. But we're definitely the rarity in that.
I'll tell you what,
no PhDs.
This talk about PhD mathematicians and investment banks got me thinking about a strategy that I might have missed, and shame on me. High frequency trading as a strategy that some of these investment banks are using?
Yeah,
Have you heard about that?
Yeah, have I heard about it? I'll go on record in saying that high frequency trading as a term, as a buzzword, is probably the most misunderstood term that I see in finance today. It's a term that has been masterfully exploited by the media. It's used as a scare tactic for certain progressions that have taken place in the world. And whether purposeful or not, the actual term of high-frequency trading that means something very broad, which I'll get to in a second, has been, again, for those reasons, vastly and grossly misinterpreted by so many people to mean one specific thing related to high-frequency trading, which typically is the part about certain kinds of firms that are very, very niche firms that all compete with each other in what we call the arms race for speed advantage, which I'll get into a second, that's based upon a trading process that involves quote stuffing, which is basically pinging the market with computers to find out where the limits of supply are to where fills might be got and where there aren't any orders, where the market's thin, so that if you find out this information, then you can get a quick little blast where you can profit from a tick because you have the ability to find out that information through the algo very quickly, and then to gain a speed advantage to grab that little tick that you're looking for in those securities. Typically, when you hear people talk about high-frequency trading that don't know what they're talking about, which is very common these days, you'll hear things like 75% of the market, 85% of the market is comprised only of these computers that are high-frequency trading like that. And they're stealing ticks from retail orders and profiting from, and they're ruining the market. So you hear that, right, as what is the synonym for high-frequency trading.
Well, I've seen the perception too. Like, let's say you have a bank and I have a bank, and then on Monday, Wednesday, and Friday, I go long, and then you short, and then on Tuesday and Thursday, I let you go long and I short. And I believe the most recent term that we've heard for that is it's nothing but a big circle jerk.
Yeah, I mean, well, here's the thing. First of all, market making as an activity, which is the parent of what you're talking about, has been around since markets have been around. Okay, somebody has to make the market. Somebody has to control all of the order flow that comes in, and all of this order flow. This notion that the only order flow in the market is institutions and money from institutions and computers is absolutely false and ridiculous. Who are these institutions? Who are these hedge funds? Who are these banks? The majority of these people are managing client assets. That's what they do for a living. So this order flow that's coming in are people that are either trading their own accounts or they're investing in funds that are managed by these people. So every day when before the market opens, again, we'll just use equities for example, you have this tremendous amount of order flow that comes into banks. And that order flow is equally split. You have people that are trying to buy into stocks, whether they be mutual funds or pension fund investors or whatever, again, which is comprised of retail money. And you have all these people that are coming that have buy orders, people that want to add to their positions, to their 401ks, to their whatever, their individual accounts. And you have other people that are trying to sell out of commission positions. They're trying to take profits on this guy who's been in a trade Netflix for a while, and he's trying to take his profit, and blah, blah, blah. And there's all these different things that are being done. So you have this order flow that's at the desk in the bank. And the bank's market makers are basically trying to get that order flow filled. So traditionally, what banks would do is obviously deal with each other to trade that order flow, because everybody on the street has this amount of order flow, and everybody's looking for different prices. Remember, these aren't all market orders. I mean, you have, a stock could be trading at $121, and bank has Bank A has order flow where he's got a whole bunch of sell orders of people that want to sell if it gets to 123. And another bank might have orders that people want to buy if it drops to 120. This is a tremendously daunting task to try to do what their function is, which is to fill these orders. So typically a bank's going to provide liquidity, and they're going to take liquidity because, again, there's never any more buyers or sellers in a market. The market can't exist, right, unless there's an equal number of both sides. So if you have more people aggressively selling, then somebody has to make the market, right? Somebody has to be able to provide a structure to fill those orders. So the only thing that's happened over, as we've had this progression of technology is that, yes, 75 to 85% of it's probably more, actually, if we're really going to talk about that, of the order flow that's being executed in the equity markets is executed by computers, because these orders have to be populated across a variety of different prices, and it's tremendously efficient to actually use things like algorithms that can take. I mean, what if you have an order for 50,000, 100,000 shares of an issue? I mean, you're not going to dump it all into 121 offer and just hit the offer, with that size. You're trying to populate the order to try to get, obviously the best price for your client, whatever you're trying to do, but while minimizing market impact, right? So you have all of these algorithms that are being employed by anybody who's making a market to make that process more efficient. So most of the trading in the market is high frequency trading. It's a matter of efficiency. And you got to remember that what used to be was that the New York Stock Exchange was it. You have human beings on the floor. They're called specialists. Each stock has a specialist that's assigned to that stock, which is still the case today. And these specialists have to manage all the order flow that's coming into them from upstairs constantly, all day long. And they have to work the orders for their clients, for everybody who's putting orders down into the exchange. So when they used to be the only game in town, of course, there was no competition. And it was a very kind of a slow and arduous process. So the spreads in these stocks used to be wide. That's how the specialist in the exchange makes money. So, back in the day, you had a stock that was, $120 bid and $120.80 offer. Well, actually, back then it was 8 1/4, and it moved to the decimal system. But so these spreads between the offer and the bids were actually money that was pocketed, right, by the exchange. Well, now, we have this system where there's, basically exchanges and what's called ECNs, which are, electronic networks that are everywhere. So orders, you have all this competition. And I'm doing my best to try to make this simple and not use kind of too many terms, but
no, you've done a good job so far.
Basically, the idea is it used to be one place, and now orders have filled all over the place, with this big spider web of a network. And because of that, we have two things. We have an incredible increase in competition, and we have an incredible increase in liquidity. And what that's done, of course, is narrow the spreads, right? I mean, almost every major issue these days is, not only tick, bid, offer, meaning, there's no space between the bid and the offer, hardly. And there's like a gazillion of, meaning like you're not going to have any problem getting filled, right? Because somewhere there's liquidity around these ECNs that's being matched, right? And we have something called Reg NMS, which basically is a regulation that said that all these orders have to be filled at the best bid or best offer of what somebody's looking for. So basically what these networks do is you look out and you find out where those pools of liquidity are. Where can you get filled for the best bid and the best offer? And that's created, like I said, this wonderful competition and this wonderful pool of liquidity that's there.
Well, if I understand this process correctly, I can't see how any red-blooded capitalist couldn't interpret this as any other way but a good thing.
Well, again, we have to go back to your friend that we talked about at the beginning of this of this conversation. Your friend called periodicity.
Okay.
The question is what's the objective of the investor? And all you really have to use is a little bit of common sense. If you're going to be entering a position in something that you're going to hold for weeks or for months or for years until retirement, what do you think is more important to you, right? Because the long-term movement of markets hasn't changed, and I can tell you that from personal experience, because this is what we do.
Wait, stop.
Study the long-term movements of markets.
Stop right there. So even with these so-called HFTs, high-frequency trading, you're saying that there's no difference now historically?
I'm saying that for the long term, for anybody who is trading or investing beyond the microcosm of trading immediate order flow in the market, which we'll talk about, that other little offshoot of HFT, which is what everybody thinks is everything, but is actually a very small part of what it actually is. It makes really no difference to a long-term position, because markets move directionally the same way that they have over big, large amounts of time. And if you're somebody who's putting an order into the market on Monday, and you're going to beat whatever it is that you buy or you short or whatever, you're going to be holding it until 6 months from now. How could what is going on between a specific set of competitors that are playing a speed advantage to scalp ticks on a bid offer between 11:30 and 11:31 a.m. on Monday, which is around the time that you put that position on, have anything to do with what's going to happen or what profit you're going to realize 6 months from now?
Yeah, it's just noise, right?
Well, right. It doesn't. I mean, it doesn't. It just doesn't. It doesn't make any sense, right? But as far as what everybody thinks HFT is the small group of companies who are trading essentially against each other, because the only advantage that they have is based on a speed advantage, and they can only get that advantage if they beat one of their competitors based on that speed advantage. Because, like you said, as soon as you go beyond the microcosm of that little thing that they're trying to do, and it's only about 100 stocks, and they're typically very liquid value stocks that don't move a lot, and when they move a certain way, and the liquidity is a certain way, and they ping the orders and figure the supply, whoever's the first one in to get short or long, beats everybody else in, scalps the tick, and pockets it. So the speed advantage for those specific firms, which I can't estimate what percentage of the market it is, but it's probably less than 5%, and probably not even that. We're not playing in the HFT game, so this isn't my thing. But I know more than a little bit about it, that this activity is 100% related to an investment in technology to see who can get as close as possible to the speed of light, which has to do with proximity to the exchange, right? The source of the data, so right. They're the first one to get the information, and obviously, there's fiber optic lines.
Yeah, I was just going to say, with the advent of fiber optic, I mean, that playing field's going to get level in a hurry, right?
Well, that's interesting that you said that, because what's interesting about all of these people who claim that HFT is getting bigger and bigger and bigger, and it's a bigger percentage of the market, they're actually really wrong about that in the sense of what they think they're talking about. Is electronic order execution becoming a bigger part of the markets every day? Yes. But the majority of that order execution is the market-making function within this vast network of providing, giving liquidity and taking liquidity amongst this massive spider web of ECNs, tier one banks, etc., that are using efficiency algorithms, high frequency trading. Why is it high frequency? It's not high frequency because it's fast and they're trying to scalp ticks out of the market. It's high frequency because it's everything is moving very quickly. There's a lot of order flow in the market. So in order to provide that service to your customers, to be able to offer them the best bid and the best offer prices so that they have their account with your bank, right, instead of one of the competitors, you need to show them that you can get their liquidity on. They have certain size needs and certain things, and those execution algorithms are very, very important to obviously to cost basis of saving, and how many blocks of trade. Like, you're a large trader, are you able to get the trade on in a shorter amount of time, or and for a reduced cost? Do you have any incentives for firms that are giving liquidity rather than taking liquidity out of the market? So rather than charging them a commission for providing the service, you're actually paying them to provide that liquidity to the market to make the markets more liquid. So it's really a vast and interesting thing that has, again, it's just gotten blown out of proportion. So yes, high-frequency trading and algorithmic execution for all of the participants in the market, I might reiterate again, most of which are these entities that are working client orders. Are some of these firms trading their own capital, proprietary? Absolutely. We may have some big changes coming up with a lot of that due to the Volcker rule, after that, and some of the divisions that are proposed to happen in investment banks, where they don't want them being able to trade against their own clients and proprietary accounts because of potential conflicts of interest and things like that. And like I've told you privately, I'm all for that. But that's a separate issue. It's like, don't commingle something that doesn't need to be commingled. But as far as the vastness of algorithms and their role in executing orders and managing the massive amount of liquidity in the marketplace, yes. But now back to what we were talking about these very, very specific firms that are very much exploiting the speed advantage for the specific purpose of competing against other firms for speed advantage, for proprietary scalping and exploiting little differences in the order flow for profitability amongst those firms. That's actually decreasing as a percentage of the trading in the marketplace over the last 2.5 years. And the reason for that is because the technology has hit a wall. You've had all of these participants that have come in that have tried to say, well, we want to get in on this HFT scalping thing and see if we can profit from it, because there's these firms that have done very well with very, very incredible programming skills and software development at this level is a heavy duty thing. Obviously, when you have that much profit potentially at stake, you're going to have new entrants into that particular segment of the market wanting to compete. But what's happened is they sort of made a grave error. They kind of forgot what they were doing, some of these firms, and like the only way that they were going to be successful competing against these other firms is if they could gain that speed advantage, right? Because that's the only way that you can exploit those differences. But now what we've got is we've hit a wall with fiber optics, right? So you've got these firms now that have come in, and these are people that you've never heard of and you'll never hear of, and the news is never going to talk about. But, I mean, there's firms that have spent $30, $40, $50, $60 million on infrastructure, architecture, to try to enter that game, that small game of those few firms that are exploiting those inefficiencies just down at the tick level, because that's the only place that it's valuable. Once you're off that tick level, you're just like anybody else in the marketplace. The market might go down, it might go up, it might, because you have all these other participants in all different periodicities doing a whole bunch of different things for different reasons, like I always say. So, once you're off that microcosm of that little spot where you can absolutely, if you're first in line, you can gain that speed advantage and grab that tick, you're only going to be competing against other firms that are trying to do the same thing. Because any other firm that's trying to buy a position and hold it for two weeks or 2 days or 20 minutes, right? It's whatever ultimately happens, and whether that trade wins or loses isn't going to have anything to do with what happens with that micro speed advantage that happens at that specific point in time.
Well, I tell you what I find interesting as a student of the market is.
Let me just finish that
Sure.
thought.
Go ahead.
You got these firms that have spent millions of dollars on this infrastructure, and they're never going to recoup that money. And now they're scrambling, figuring out, can we sell this infrastructure that we bought to somebody else, one of the competitors, that's maybe the lead competitor, and it's like, oops, we stepped on our dick here, and we're not faster than you, so do you at least want to hire our people and buy our servers, whatever, because we're screwed, right? And that's the reality. That's what's been happening in the last few years. However, there's an offshoot rather of this, and that's that the arms race has now gone to the next level, which is that they've discovered that potentially they can use microwave technology, and microwave technology is about 30 times faster than the speed of light. So up until now, data has been limited to the speed of light. So anybody who knows anything about data, computers or whatever, a little bit about this intrinsically, right? And that's that, we started out with Category 3 copper, and then we went to Category 5, and then we went to Category 5E, and then we went to Category 6 and Category 7. And every time there's a bandwidth advantage, right, to this better cable. And then, of course, the next step after that is we went to fiber, right? So all we're trying to do is narrow down into the speed of light, because up until now, that's how we receive data, is based on the transmission of light. And then as soon as you reach that, that point of critical mass, it can't be any faster unless you use a different technology. So microwave, we have to see what happens with microwave. It's tremendously expensive. And, of course, there will be an arms race based on microwave that has to do with people who are trying to exploit the speed advantage at the tick level. But, again, once you get off that tick level, what difference does it make? I mean, we've studied markets as extensively as anybody. I mean, to the point of going to the New York Public Library and getting reports on grains tradings from the 1800s, when people used to throw, bushels out the window and yell at each other in the street. And the long-term motion of markets hasn't changed. And not only do we know that through research, we know it through practical experience. We certainly weren't trading our models in 1950 or 1970 or even 1980. But I can tell you that the performance and the way the markets move and the way that the models capture directional and non-directional movement today is absolutely no different in those longer-term periodicities than it was in 1950, 1970, 1980. So this notion that short-term noise is the result of computers and high-frequency trading is just hogwash. I mean, there's a lot of reasons why markets are noisy. If the definition of noise is less directional movement and commitment towards big, long trends and directional movements in markets, and that has everything to do with other major things that are going on in the world that have to do with interest rates and the Fed and the money supply and debt loads and things like that are absolutely affecting the way markets are moving in the short run. But the notion that as a longer-term retail investor, or even as a trader that's trying to capitalize on a particular movement based on a particular strategy over any period of time that isn't that short-term, it's just not there. And you really need to start looking to yourself and stop trying to blame somebody else, and maybe blame the fact that you got to find another way to be profitable.
Well, something that any of us can never forget, whether you're the CEO of Goldman or what you do, Robbie, or what I'm putting together over here, we can never forget the main purpose of a market and what it is built to do. It's to eliminate price inefficiency. It's
a billboard to advertise prices. Every market is a billboard to advertise prices.
And if there's an inefficiency in the pricing, it'll be found.
Market's always right.
And yes, it will be eliminated. Now, while we're talking about the real long haul people, I got maybe 5 minutes left here. Warren Buffett, just the poster boy of the stock market in the United States. I think he's maybe categorized as a buy and hold fundamental type person. Just
very much so.
using using him as an example.
Yeah.
But now a person who follows his buy and hold, if I'm just doing buy and hold, like if I go long on the S&P, can I think that I am operating the same way that Buffett is operating?
No, you can't. He's look. Buffett is an amazing guy and a genius investor, and probably not for the reasons that most people would count for his genius. People tend to look at his specific stock trades and things that he's made and try to judge him on his value to predict what's going to happen in this or the other. In which case, you hit some and you miss some, just like anybody. But it's important, I think, to recognize that Warren Buffett really isn't a buy and hold investor in the sense of somebody who would be like a retail guy who's taking a position in the stock, which is absolutely inconsequential in terms of the size of that position as a percentage of the outstanding shares in that market. Every retail trader, almost no matter how big they are, I mean, even if they're multi-millionaires taking a position in the stock, is inconsequential to the float of some of these companies, right? Or most of these companies, I should say. Warren Buffett is in the acquisition business, not in the buy and hold investing business in the sense of taking a position in the stock. He is doing what he does in order for an attempt to take control. And through that control and the resulting structure as a result of that control, he's trying to create a situation where he's going to be in the income business as ultimately being an owner of that company. I'd be willing to bet that every position that Warren takes that's significant in any company, if you got into his head, just personally, like you could get in there and make him tell you the truth, inject him with truth serum, he would tell you that secretly he has a design to own it outright, if he could, every single company that he buys, because he likes them that much on a fundamental level. And he's certainly done that with so many companies. I mean, a lot of people don't really probably even realize, some of the companies that Berkshire. I mean, a lot of people don't realize it. Warren has a company called Berkshire Hathaway, which is essentially a conglomerate and a holding company. But some of the companies that Warren owns, I think, would maybe a lot of people, they think of him just as an investor. Oh, he's that guy that that made a play for Bank of America and did all this. He's known for some of his positions in metals and things like that he's owned. But he's he's been around a long time, and Berkshire owns I don't know off the top of my head. He owns half of Heinz, the ketchup company. What else? Fruit of the Loom, Dairy Queen.
They got Coca-Cola?
NetJets, Coca-Cola.
Yeah.
He's got a pretty big stake in American Express. I think he's got, I want to say 15% maybe of Amex. He doesn't have a majority stake in Coke. I think he's got 10% or so.
Oh, is it?
Yeah.
He was he bigger in that before?
There's a whole story with Coke, and I can't.
I
know that a guy that had the most of the bottling plants and distribution centers from Chicago to the Midwest sold out. A guy named Marvin Herb, and I know that Warren took some of his stake, but I forget all the rest of that stuff. But just everything. And
people would be anybody listening. If you Wikipedia Warren Buffett, The Wikipedia page for Warren Buffett is really, really cool.
Actually, he owns close to 3% or 2-3% of Walmart. Which is a tremendous stake in Walmart. I mean, really, if you think about it, he's Washington Post, Wells Fargo. I mean, I can't think of them all. But really, what makes Warren a genius, and a lot of people don't realize this, is the fact that normally, when somebody is in the acquisition business, they have to leverage the companies that they acquire. Typically, have to leverage obviously the revenue and the cash flow of the companies that they acquire. And I've always been sort of impressed with this one facet of what Buffett does, which I think is really interesting. And a lot of people don't know this or don't realize this, but Buffett's also in the insurance business. And what he does is he actually uses the overfunded insurance premium accounts, in other words, that he doesn't have to pay out in claims and that he doesn't have to hold in reserves, to finance basically all of his investments. So here's a guy who, has this, obviously he's got Berkshire Hathaway, he has this tremendous share, obviously he's a majority shareholder in Berkshire Hathaway. I think he's got, 30,000 of the A shares. So, I mean, you're talking about $4 trillion worth of market value in Berkshire Hathaway. Of course, he couldn't, cash that out. Here's my 26,000 shares at $175K a piece. But the point being is that Berkshire keeps acquiring these companies, and they never have to leverage the debt or the assets of the companies that they acquire. And he basically just uses the cash spin-off from the insurance premiums to finance basically all of his deals.
So he's always staying in the black.
Absolutely. I mean, Berkshire's got, I don't know, $175 billion in annual revenue. You're talking net income of $15-20 billion a year, which it's pretty much just gravy. And even the structure, even the way that he structured the A shares versus the B shares in Berkshire, where the A shares were purposefully sized and were never split so that they can never be a part of the major indexes. So you got a stock that trades at $175,000 a share that isn't a member of the S&P 500 or the Dow. So you keep that institutional interest down to a minimum. I mean, institutions own the other third basically of the float, and 60 some odd percent or so.
I'll tell you what that is.
The B shares, right? All the sheep are out there just trading the B shares of Berkshire. Yeah. Which is now, the Berkshire B shares are.
Well, there's still a couple grand, right?
Right, and so they're so he gets all this action from the B shares that are going to be subject to the indexes and walk up, through the correlation. So he's always gaining equity from just the long-term creep of equity markets over decades, that he has for a long time. And he's financing these deals with insurance money. He never has to. And so then he's fully cashed out these merger and acquisition deals. And then they're just in each one of those is the gravy train, and they become wholly, owned subsidiaries of Berkshire. And he just keeps stacking them on.
Well, I'll tell you what, the way that if we can put a cap on it, because obviously we could go on quite a ways. The way that Buffett is acquiring his, for all intents and purposes, buy and hold positions in these interests, it is like ridiculously low risk because he's in the black.
Absolutely.
He's only moving forward. There's little downside with the way he's operating.
That's right. Yeah, his risk model through the ultimate end place in the grand scheme of things of what he buys is tied to that, so to speak.
Awesome.
So he doesn't have to really think about managing his risk as a buy and hold investor in the same way that somebody who's a retail buy and hold investor has to. It's very difficult, but managing your risk as a buy and hold investor, as a retail buy and hold investor, all things being equal, is tougher than managing your risk as somebody who is trading in any periodicity, even long-term periodicity, with a specific risk-reward objective.
Yes.
It's much, much easier than hoping, that just your diversity in your ownership portfolio and things like that, and the way that you hedge it, are going to be complete enough to really function the way that you want them to from a risk perspective. So,
yeah, good stuff, man. I gotta bounce off here now.
What time is it?
It is 4:09 according to the clock on the wall.
All right, yeah, we've been on long enough.
We've been going at it for an hour and 40 minutes now.
Is that right?
That is right.
All right, so did we get what you want?
Well, we're still recording.
Well, good. Well, what else do you want to say?
I'm all set.
All right.
We'll continue this on. We got a part 3 and I think a 4 coming up too.
All right.
Yeah. Keep the audience guessing, wanting more, a little bit surprised. Hopefully they like what they see or hear. Come back for more.
If they're not sick of me by now.
I think if anybody made it to this point, man, we may even be able to do requests.
Fair enough.